If you're a business owner or an entrepreneur, you might be familiar with the flexibility and protection offered by LLCs. But as businesses grow and evolve, sometimes the structure of an LLC might not serve all of your needs. Today, we're diving into some key scenarios where it might make sense to consider moving beyond an LLC. Whether you're looking to attract significant investment, plan for an IPO, or even expand internationally, understanding when to transition can be crucial for your business's success. So let's explore these situations and determine if this change could be right for your business. When starting a business, many people opt for an LLC due to the simplicity and flexibility of the structure. One of the biggest advantages is the protection that an LLC offers. This means that as an owner, your personal assets are protected if your business faces lawsuits or debts. Furthermore, one of the appealing aspects of an LLC is the reduced administrative and financial burden. LLCs typically require less complex tax filing and accounting processes, which means they often incur lower accounting fees than corporations. Similarly, the payroll processes for LLCs are usually more straightforward, particularly for businesses operating on a smaller scale or within a single state. Another appealing feature of LLCs is the pass-through taxation, where profits and losses can pass through to your personal tax return, avoiding the double taxation commonly associated with corporations. Additionally, LLCs benefit from a lack of rigid corporate structure and rules. Unlike corporations, which are required to have a formal board of directors, hold regular board meetings, and maintain extensive records, LLCs do not require such formalities. This means less paperwork and more straightforward governance, which can be especially advantageous for smaller businesses or those just starting out. But as straightforward as LLCs are, they might not always be the best fit as your business grows and your needs change. Investors and venture capitalists generally prefer C corporations for a few key reasons. The structure of a C corporation is well suited to investment because it allows for the issuance of different classes of shares, which can cater to various investor needs and preferences. This flexibility is crucial for attracting a diverse group of investors. Additionally, C corporations facilitate an easier process for transferring shares. Unlike LLCs, where transferring membership interests can be cumbersome and often require the approval of other members, shares of a C corporation can be sold or transferred without significant hurdles. This ease of share transferability is especially appealing to investors who may seek to exit their investment through a sale or trade on public markets in the future. Moving beyond the realm of private investment, let's consider another juncture where a C corporation becomes beneficial, and that's going public. For a business to list its shares on a public stock exchange, being incorporated is a requirement. This step transforms a private enterprise into a public one, accountable not only to its shareholders, but also to regulatory authorities. Incorporation lays the groundwork for an initial public offering or IPO, where shares are offered to the public for the first time. Corporations, unlike LLCs, are required to adhere to stringent regulatory and reporting requirements that include the preparation of detailed financial statements, regular disclosure of financial and business operations, and compliance with governance standards such as having a board of directors and conducting annual shareholder meetings. These measures, while demanding, are crucial for maintaining investor confidence and ensuring a fair market. Furthermore, the ongoing requirement to file quarterly and annual reports with the Securities and Exchange Commission provides a continuous overview of the company's financial health and strategic direction to the investors and the public. Another advantage of a corporation is the role of employee incentives. Corporations have the unique ability to offer stock options or employee stock purchase plans, which are powerful tools for attracting and retaining top talent. Stock options grant employees the right, but not the obligation, to purchase shares of the company at a predetermined price, often called the strike price, after a certain period known as the vesting period. This opportunity allows employees to benefit directly from the company's growth and success. Similarly, employee stock purchase plans enable employees to buy company stock at a discount, often through payroll deductions over a set offering period. This not only makes it easier for employees to become shareholders, but it also boosts their commitment to the company's long-term success. Another compelling reason to consider transitioning to a corporation, particularly when eyeing international expansion, is the global recognition and adaptability of the corporate structure. Corporations are more favorably viewed by foreign governments and business partners. This familiarity can significantly ease the process of establishing operations in new markets. Moreover, international business expansion involves navigating more complex tax landscapes. Corporations can benefit from international tax treaties, which are agreements between two or more countries designed to avoid the double taxation of income earned in overseas operations. Additionally, corporations might find it easier to set up subsidiaries in foreign countries that can operate under the corporation's umbrella, benefiting from its established reputation and operational framework while adhering to local business practices and regulations. For businesses experiencing growth and higher income levels, the corporate tax treatment can offer advantages. Corporations are taxed as separate entities. This means they pay corporate income tax on their profits, and then dividends paid to shareholders are taxed again at the individual level. This might sound less advantageous at first, often referred to as double taxation. However, at higher income levels, the ability of a corporation to retain earnings at a potentially lower corporate tax rate can be beneficial. Contrast this with LLCs, which are typically treated as pass-through entities for tax purposes. This means that all profits and losses are passed through directly to the owner's personal tax returns and taxed at individual income tax rates. While this avoids double taxation, it could result in a higher tax burden if the individual tax rate exceeds the corporate tax rate. Moreover, pass-through taxation means that all income must be distributed and taxed in the year it is earned. Unlike corporations, LLCs cannot retain earnings for future investment without taxing the owners. Additionally, corporations can benefit from certain tax deductions and credits that are not available to LLCs. These can include deductions for employee benefit programs and certain types of business expenses, which can make a difference in overall tax liability. Therefore, for businesses that are scaling up and generating substantial profits, the corporate structure might not only provide a tax-efficient way to manage and reinvest earnings, but also leverage tax planning strategies to maximize their financial health. In discussing the transition from an LLC to a corporation, it's also worth noting that many businesses opt to register their corporation in Delaware. This choice is prevalent among entrepreneurs and established companies alike, and for good reason. Delaware is known for its business-friendly legal environment. The state offers a court of chancery, which is a specialized court that deals exclusively with corporate disputes. This court does not use juries, but instead utilizes expert judges, which lead to quicker resolutions and more predictable outcomes in legal disputes. Such an environment can be highly advantageous, particularly for corporations that may face complex legal challenges. Additionally, Delaware's tax laws are also favorable for corporations. The state does not impose corporate income tax on companies that are formed in Delaware but do not transact business there. This tax structure is an advantage for corporations that operate in multiple states or internationally. As we've explored the benefits and opportunities presented by different business structures, it becomes evident that transitioning from an LLC to a corporation is not a decision to be taken lightly. The transition process itself requires a deep understanding of federal and state laws. If you're contemplating this significant step, or if you have any questions about what we've discussed today, feel free to reach out to us at DeMar Consulting Group, where we specialize in helping businesses navigate these decisions. I encourage you to book a consultation with us by clicking the link in the description below. This is your opportunity to discuss your business needs with seasoned professionals who can help pave the way for your business's future.